Hello, Melanie. How you doing? Melanie is mute. Hey. Hi, Kate.
Okay, sorry about that. Hello.
Oh, hi, Melanie. Good to hear from you. And Kate is with us as well.
Okay.
In looking at the schedule, it looks like you guys have a test next week on chapters 1, 2, and 3. And this gives us two sessions to do something about it. Have we already gone through chapter 3? I believe we have, right? Not yet?
I don't believe so, no.
Okay, all right. Let's presume that today I'll take us through chapter 3, and then Tuesday, a week from today, we can have a good test review for the test on the following day. Okay.
Okay. If I could just let you know,
Sure.
because there aren't too many people here yet, I do have to cut out a little early. I was
Okay,
just gonna be here for what I could and then come back to it.
that's okay. I'm used to driving my audience to the exit. That's okay. Thanks for the heads up. Okay, let me get going here. There's Kate. How you doing, Kate? All right, let me find my shtick here. All right. So 110. Oops, wrong. Chapter 3. Chapter 3. Modules. Chapter 3. Okay, so far so good. Let me share the screen. Okay, we see the screen, Melanie?
Yes.
Okay, here we go. Chapter 3. Here's where we're going to get into the debits and the credits, okay? The debits and the credits, and this is the language we have to master if we're going to go any further with the class, okay?
Mm-hmm.
We're going to talk about a T account, and we've worked a little bit with T accounts. T account is really a piece of scrap paper when you think about it. It's a way to organize the data, but it does mimic the general ledger. So we're going to consider these T accounts our general ledger, the books of the company, and it's shaped like the letter T, I believe, huh? Debit, credit. Debit means left. Credit means right. Debit means left, credit means right. There's no value judgments here. One is not better than another. Credits must equal debits at all times to keep your accounting equation in balance. Debits must always equal the credits. Every transaction you prepare is going to have at least one credit and one debit, okay? Now, in the earlier chapter, we discussed changes to the balances in terms of increase, decrease, higher, lower, up or down, more or less. Here, we're going to try to start speaking the language of accounting, which is we're going to debit the account or we're going to credit the account and know which one is increasing and which one is decreasing. And that's done according to a few rules. Okay, so the abbreviations DR, CR, debit, credit, all it means is it's debits on the left, credits on the right as we get started. And you're going to have one T account in your general ledger. You're going to have one journal. We can call this a journal if you like. You're going to have one journal account for every item in your chart of accounts. So they're showing you one for cash as an example. You're going to see one for accounts receivable, inventory, supplies, prepaid insurance, accounts payable, going on down the line all the way through your revenues and expenses. Okay? And whether an item increases or decreases depends on the rules of the debits and the credits. So let's see what we have here. Every T account has an increase or decrease side. Some accounts increase on the debit side and some increase on the credit side to confuse us, okay? The debit side is always on the left. The credit side is on the right. All right, so let's get that under our belts here. Debit on the left, credits on the right. And so let's look at a T account with a few numbers in them. I'd like you to take a look at cash. Here's cash. Balancing a T account. How do we do it? Step one, we add the total on each column. In this case here, we have $3,500 on the debit side. We have $3,130 on the credit side. The difference between those two numbers, I believe, is $470. And that would become, or 370, that would be the balance. Make sense? You add the two columns down and the high man wins. So in this case, cash has a debit balance. We're going to call it a debit balance of $370. And cash is an asset, and assets always have a debit balance, no exceptions. So we find the balance by getting the difference between the two. And there you go. It's simple as that. Okay. In other words, this company started with $2,000 balance in cash. Then they spent $1,200. The balance was $800. Then they got $500 more in. That made the balance $1,300. Then it went down to $1,100, etc., until they ended up with $370 at the end of the month. Describe the effects of the debits and credits on the specific types of accounts. Now, here's where it's getting a little difficult for you until you do enough homework, enough review to be comfortable with the rules of the debits and credits, okay? When we say debit an account, we mean it's going to go on the left side. When we say credit account, it goes on the right side. And keep in mind that debits may increase an account or decrease an account. And the same is true for credits, okay? Debits may increase depending on what the account is, and credits may do the same thing. Okay, take a deep breath. Here we go. Assets. Assets increase on the debit side. There's no other way I can teach that is just to tell you and do enough homework, go through it, think about it enough. Assets are increased on the debit side. That is called the normal balance of the account. Normally, assets have a debit balance. Cash, you remember, had a debit balance of $370. That's an asset. Assets increase on the debit side. Assets have a debit balance. If assets have a normal debit balance, and our equation is assets equal liabilities plus equity, then the liabilities and equity would be the opposite. Liabilities will increase on the credit side, So all your payables increase on the credit side. Capital, owner's equity, net worth, stockholders' equity, increases on the credit side, just like the liability accounts. So there's three rules right there. Assets have a normal debit balance. Liabilities and owner's capital have normal credit balances. Whoops, excuse me 1 second. Assets, normal debit balance. Liabilities and capital, normal credit balance. Now we come to two more things, really. Revenues and expenses. Revenues, these are your sales. Revenues increase on the credit side. Revenues have a normal credit balance. Anytime we record a sale, it's going to be on the credit side. In fact, you would never debit the sales account, never.
No.
We'll learn why as we go along. If revenues go up on the credit side, expenses would have to go up on the debit side. Expenses go up on the debit side, just like assets. And then finally, and temporarily, we bring drawing into the picture. After the first exam, I don't think we're gonna see the words drawing any longer. This is just we just put this into the curriculum to show you how in a small business an owner can come out and draw money from his company. And this is an equity account, but it has a debit balance. Drawings are increased with a debit, and in so doing, it reduces equity, which has a normal credit balance. Equity is the master, and below that is the net income and the drawing. And now we're going to look at a couple pages that might help you learn these rules a little more. Assets, debit balance, liabilities, credit. Owner's equity has a normal credit balance. But look at the components of owner's equity. You have the revenues, which go up with the credit and which increase the equity. You have the expenses, which have a debit balance and thus decrease the equity. And the drawings have a debit balance, and of course, they also reduce the equity. Okay? These are your 6 rules here. I think this is the best grid to study from. On this, you only have to look at one column. I would look at the column on the right, the normal balance. It's going to be the same as the increase. You can look at the increase column then. Increase column, assets, debit, liabilities, and equity, credit, revenues, credit, expenses, debit, drawing, debit. You'll be surprised how tricky this is to start working with when you get going with the homework and the assignments. It's only 6 things, but it really gonna blow your mind for a little while anyway, I think, if you're like most students, okay? If I say to you, accounts receivable, what's the normal balance of accounts receivable, debit or credit? Anybody want to answer that one?
On accounts receivable, it would be debits.
A debit, because it's an asset. Yeah. What's going to happen is you're going to be hesitating a little bit, like my 110 class last night, the face-to-face class, where I went around the room and said, let's see if we can all make a layup here answering these debit and credit questions. And they didn't get too many right, actually. They got 50% right, which seems like a random number. Tells me they're guessing. So anyway, this chart here might be of great use. Now we're going to use T accounts to analyze transactions, and we're not going to go through all of Mitchell Williams' transactions again. Okay, for the 3rd time. Steps in the transaction analysis. Be sure you understand what's happened. The electric bill is here. That's what happened. We have to see if it's a reasonable number, and if so, we have to record it. What accounts are impacted? Well, let's see. Cash, we're going to pay cash for this electric, and the electric is an expense, and keep the accounting equation in balance at all times. So here's our famous first transaction, huh? He invested $5,000 in business. So what are the accounts that are going to be affected? Cash and the capital, right? The cash is going to go up because he put $5,000 into the business, and the capital goes up commensurately with that, 5,000. And then we want to classify them as assets or capital or liabilities. We do that. And now we're going to say the transaction is entered as an increase in an asset and an increase in owner's equity. Therefore, we debit cash and credit capital for $5,000. And this is your general ledger now. You have a debit of 5,000 and a credit of 5,000 here, and we're in balance. Purchased an asset for cash. Here, we're just exchanging one asset for another. So one asset goes up, one goes down. So the one that goes up, we're going to debit. We're going to debit delivery equipment because that's what we just purchased. And we're going to credit cash for 2,000. And here it is here. Cash goes down 2,000 because we credited it and we debited delivery equipment. Purchase an asset on account. On account and no money's involved in the transaction. So again, we bought delivery equipment. So we're going to debit delivery equipment, but accounts payable goes up. Okay? We didn't pay cash. We're not going to credit cash. We're going to credit accounts payable since liabilities have a normal credit balance. And there we see it. There's the 1,800 going into delivery equipment and accounts payable. So you see how the T accounts start building themselves?
Yeah.
Payment on account. Mitch paid the first $600 on the scooter. What accounts are going to be affected? Cash and accounts payable. And they're both going to go down, right? Cash is going to go down because we're spending the money. And our bill to the vendor is going to go down by $600. Therefore, we're going to debit accounts payable to reduce it and credit cash to reduce cash. And there we go. We now have a balance left of 1,200 in AP, and the cash numbers moving up and down as we go along. Delivery revenues earned in what? Earned in cash. Okay, he went out and he delivered his pizzas around the campus, and he collected $2,100 in cash. So cash is going to go up, and so are revenues, which we're going to call delivery fees. So we're going to debit cash, credit delivery fees. Every transaction has to have at least one debit and one credit. That's why it's called double entry accounting. You could have one debit and 100 credits or vice versa, as long as the debits equal the credits. So we're moving along here. He paid the rent. The rent expense is going to be going up. We're going to debit the rent expense for 1,000. And since we paid for it, we're going to credit cash. So we increase the rent expense with a debit, since expenses have a normal debit balance, and we're going to credit cash. And now we got our first expense later in there. Oh, another expense. Paid for it again in cash. We're going to debit the expense, phone expense, for $100 and credit cash. Credit cash. Okay. We go. Deliveries earned on account. Delivery revenues earned on account. Here, he delivered his pizzas, but our customers aren't going to pay us for a while. They're going to pay us in 30 days. So what asset goes up? Not cash. Accounts receivable goes up with a debit. We're going to debit accounts receivable to increase it, and we're crediting delivery fees to increase the revenues. And here you see the 2,400 coming there. And now we have accounts receivable. That's money we're going to collect in the future. Purchase of supplies for cash, $80. Whenever you buy supplies, they're not an expense at that point in our course. It's going to be an asset, a prepaid asset. So supplies is going to be debited and cash is going to be credited for 80. Supplies goes up with the debit and the cash comes down with the credit. Debit and credit, debit and credit. Cash receipts from prior sales. Okay, remember that we just had a couple of slides ago, we had $2,400 sale, I believe. Now he's receiving 1,900. He received the cash, but this does not affect the revenue. The revenue is recorded when he sold the pizzas. So all we're doing here is we're collecting the cash and reducing another asset called accounts receivable. So whoever this customer was, he paid $1,900. We're going to debit cash to increase it and credit accounts receivable to decrease it. It's just an exchange of assets, if you will. And here's the exchange here. Cash went up with a debit 1,900. Accounts receivable went down 1,900, leaving a balance there of $500. Purchased an asset on credit, but he made a down payment, a partial payment. Mitch bought a third motor scooter for $1,000. Okay, well, we know that equipment's going to go up. He calls it delivery equipment. He made a down payment of $300, so we know cash is going to be reduced, and the remaining payments are going to come in the future. We know that accounts payable has to go up. The way we're going to express it is as follows. We're going to debit delivery equipment for $700. We're going to credit cash for $300 and credit accounts payable for $700. And here's the delivery equipment, the 1,000. Here's the 300 credit to cash and the 700 credit to accounts payable. So the debit to delivery equipment increases the asset. The 300 credit decreases the cash, and the 700 credit to accounts payable increases the balance because that's the normal balance of a liability. Payment of the insurance premiums. By definition, when you buy an insurance policy, it's an asset. So he bought this asset for $700. We're going to debit an asset called prepaid insurance and credit cash. We're going to increase prepaid insurance with the debit and credit cash for $700. There's our prepaid insurance, and there is our credit to cash, and we're still in balance going across, okay? Uh-oh, he paid the wages. He paid salaries. Well, wages is an expense. Wages is an expense. Expense has a normal debit balance, so we're going to debit wages and credit cash. Debit wages expense and credit cash. This thing's really getting a little fat now, huh? Now here he made deliveries for cash and credit. He delivered $3,500 worth of pizzas. Well, that's going to be his revenue, $3,500. And we know now that we credit delivery fees to increase it. He received $900 in cash, so we know we have to debit cash for $900, and he got $2,600 to be paid later. So we debit accounts receivable. Every one of these three items, they all increased the balance, okay? And then finally, we have a withdrawal. And like I said, we're not going to see any more drawings after the first next couple of weeks. But Mitchell took $3,000 out of the business to pay for his trip to Las Vegas. Cash goes down by $3,000. And because we know this was for his personal use, we debit drawing. We debit drawing, which is going to reduce the equity, right? The equity has a normal credit balance. So when we debit drawing, which is part of equity, we're actually reducing the equity, and we credit cash to reduce the cash. Drawing is not an expense. It's a reduction in the net worth of the company. He's given himself $3,000 worth of the company. Now, we have all these balances sitting there, huh? Now we're ready to prepare the financial statements. okay? So think of this as your trial balance. And here are all the balances sitting there, okay? Prepare a trial balance, explain its purposes, blah, 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 blah. The trial balance is simply a listing of all the balances in the general ledger at the end of the month. The sum of the debits must equal the sum of the credits. And the trial balance serves two purposes only. One, it demonstrates that the debits equal the credits, okay? Going forward with computer systems, you're not gonna have to worry about that, I don't think. No system is gonna let the equation go out of balance, I wouldn't think. And the other thing useful with the trial balance, it's a great source for preparing the financial statements, which we'll see in a moment. And the trial balance is prepared periodically, typically at month end for sure. But you might run it during the month if you wanted to look at something. But typically, it's a month end worksheet. It's going to list all of the accounts, all of them, and their balances. And then we prove that the accounting equation is in balance. And the trial balance, by the way, is not a formal statement or report. It's a worksheet. No one's going to ask to see your trial balance. It's of no interest to anybody except the accounting operatives. And it's used to prepare the financial statements. Keep in mind that the trial balance is in a specific order: assets, liabilities, equity, revenues, and expenses. Assets, liabilities, owner's equity, revenues, expenses. And here it is. Here's our trial balance. Cash, 470. Accounts receivable, 3,100. Supplies, 80. 700 for prepaid insurance. Where did we get these numbers? We got them right from the general ledger. There's the 470, 3,100, 80, 700, 4,800. So we picked up the balances right from the general ledger. So now we're assuming that this trial balance is okay. In a future chapter, you're going to learn that there's a lot more work to be done on the trial balance. But for now, we're assuming that this trial balance is absolutely perfect. Remember the order it's in: assets, liabilities, equity, and then revenues and expenses. Therefore, if you go to the line that says your first delivery fee line, and you draw a horizontal line going left to right, everything below that line, starting with delivery fees, is your income statement. Everything above it is going to go on the balance sheet. So that's a good tip to remember. After the drawing, everything below drawing is going to be your income statement. Everything above drawing included is going to be your balance sheet. So armed with that, we can start to put this income statement together. So let's see what we have here. Delivery fees are $8,000, right? Those are our revenues. We had three expenses. We had $8,000 in revenue. We had three expenses: $1,000 for rent, $100 for phones, and $1,650 for wages. Here they're breaking the trial balance out by color to help us. Can you read these numbers okay? Okay. Look at the income statement. We brought the 8,000 over, and we brought those three expenses over. And we set it up in a nice format: Mitchell's Campus Delivery income statement for the month ended. And it should say for the month ended, or for the month of, or the month ending. It's got to say something like that, because these are cumulative numbers and not a point in time. So he had 8,000 in revenue. We add up his expenses, which came to 2,750. He earned a very nice profit of $5,250. Okay. keep in mind that you have to do the financial statements in this order. They have to be done income statement first, then the equity statement, statement of owner's equity, then the balance sheet, and then maybe cash flow statement. So the reason we do the income statement is we have to flow it into the owner's equity statement. So let's go back and look at the trial balance here. Owner's equity, huh? I see 5,000. That's at the beginning now. This is what the balance was at the end of the month. That becomes our beginning for closing purposes. And he had drawing of 3,000. So let's see how that works out. This here is not a hard statement if you divide and conquer. Your beginning number, which in this case is 5,000 beginning, plus net income minus drawing equals your new ending equity. You like an acronym? Bide your time. You know that expression, bide your time, B-I-D-E? Beginning equity plus income minus drawing equals ending equity. Any questions on that, Melanie?
No, I don't think so. And it
Okay.
seems pretty clear. However, this is a good break. I do need to check out right now.
Oh, okay. So we say this is the last slide anyway.
Okay.
I think we're done in like 20 seconds.
Okay.
But you
Then
can
I'll-
look at bricks if you need to. Okay. So we came up with our new equity number 7250. Look at the balance sheet now. We're just going to copy everything from the balance sheet except what number? The capital number, because that's now changed. The capital is no longer 5,000. The capital is now 7250. And that's what we bring down. And there we go. Assets equal liabilities plus equity. Okay. And that's the quick man's tour of debits and credits. So you just have to get those debits and credits in your head. And from what I'm seeing here, I don't think you're gonna have too much problem with that. Okay. All right, Melanie, if you have to leave, that's
All right.
fine.
Thank you.
We'll see you next week.
Okay.
Bye-bye. Okay, you and me, huh, Kate? Any questions, Kate?
No, I feel like I have a good handle on this. I read the chapter and
That helps.
maybe I did some homework. I don't know, but I feel like it's kind of clicking. The acronym you gave me last week was super helpful. The after eating dinner, let's read comics.
Oh, okay, good for you. Yeah,
So I just kind of like think of that one, but
after eating dinner, let's read.
Yeah. yeah.
Yeah, I got that
So-
from another teacher. Yeah, so this one here,
But-
you bide your time on the,
Yeah, I wrote that one down too.
yeah,
it's
students
good.
usually don't have any trouble with the income statement, but they get themselves all flummoxed over the owner's equity statement. And like I say, it's really 4 lines. You notice they have a subtotal
Mhm.
here? You don't even need to put the subtotal in for the change, if you will. 5,000 plus that minus that would be fine. Okay.
Hmm.
And then the balance sheet, you copy everything over except the one item that did change, which was the equity. We're not going to bring the drawings over to our financial statements. That's nobody's business, right? That comes out of the business.
Right. Okay.
This is the business after the drawing. I mean, we could have left it in there, but then that would have just confused people more than anything else. So,
Okay. And on the statement of owner's equity, it's always you add the net income first and then less withdrawals.
absolutely.
Okay.
That's all there is to it.
Okay. Right. Because those are only the 2 things that have changed
As you
during
go
the
forward in accounting.
month or whatever.
But for now, yeah, that's all you have to worry about.
Okay. And you said that, and I think I read this somewhere, that most modern computerized accounting systems, they won't let you put in the transaction incorrectly.
That's
Or-
my story, and I'm sticking to it.
Okay.
Well, you can make mistakes, of course. You can put in wrong data, but if you accidentally debit, suppose you tell the computer, we received money. I want to debit cash and I want to debit accounts receivable when you meant to credit it.
Okay.
That kind of entry, no system should accept. No system should.
Right.
That's all I'm saying.
Okay. Like it won't, right. It won't let you put in 2 debits or 2 credits.
No, no.
Mm-hmm.
I don't see how any system worth its salt could even permit that to happen.
Could you put in like, could you reverse it and it still accept it? Like instead of debiting cash and crediting, let me think, like an accounts payable, could you reverse it and it still accept it?
That
Do you know?
could happen depending on how you set it up. Yeah, that
Uh-huh.
could happen.
Uh-huh.
What you learn eventually is that companies don't write journal entries for all this activity. They have certain defaults they can build into their software, where if they want to go in and pay the bills, they don't do it line by line via a journal entry. They go into what's called the cash disbursements journal, where
Uh-huh.
they put down the debit, and then all the totals automatically flow into cash. You don't do it one by one, so that's a default that would protect you on that as well.
Mm-hmm.
But yeah,
Okay.
if you make a mistake, if you tell the system to debit Mitchell's capital by mistake and credit rent expense or some silly thing, yeah, it'll let you do something like that. But that's up to you. That's operator error, you know.
Yeah. Yeah.
So
Okay.
not too bad, huh?
No, it's not too bad. Yeah. That was one of my friends. I was like, do I really need to take this class if I'm just gonna like learn QuickBooks or whatever? And they're like, yeah, because it's easy to mess up QuickBooks.
Oh yeah, I mean I worked in QuickBooks a long time ago. Yeah, if you don't know what you're doing when you set it up,
Mhm.
no, absolutely.
Yeah.
You know, you get involved
So,
with reversing entries and accrual entries and repeating entries. If you don't set all those defaults correct, you'll have a disaster on your hands.
yeah,
You know,
but
garbage in, garbage out, right? With the world of
that,
computers.
that's right.
So, you okay then, Kate?
Yeah, I feel good. Yeah, thank you.
All right, the rest of the class is dismissed. I hope you all have a good weekend wherever you are. I will see
Thanks.
you
You
later,
too.
Kate. Bye bye.
All right, see you later. Take care. Bye-bye.